If you're living paycheck to paycheck, you're not alone. Most of America is struggling just paying their bills. But it doesn't have to be that way. If you want to actually stop living paycheck to paycheck, there are 3 things that you need to do in this order. I'll show you. You need to create 3 different bank accounts. Then you need to systemize your money, and then you want to automate the process. Let me show you what I mean. The first thing you need to do is create 3 different bank accounts, one for your spending money, one for your investment money, and one for your savings money. And the reason why you want these in different bank accounts is so you don't get tempted to accidentally spend your investment money or your savings money, because when you keep it all in one account, you might be the best bookkeeper in the world and you say, I know $1,000 is for investments and $500 is for savings. But when you go to the store and you see the sale on the TV, it's very easy to think, oh, I got $3,000 in my bank account, I can spend $2,500 on this TV, and now you accidentally just spent your investment money and your savings money. So go out and create 3 different bank accounts. But this is where you have to also do number 2, systemize your money. This way, anytime you get paid, you always have money to save, you always have money to invest, and then you spend whatever's left. Let me show you. Now that you have 3 bank accounts, you might say, all right, I'll go live my life, pay for my expenses, and then when I have some extra money, I'll put some of that money into this investment account, and I'll put some of that money into the savings account. But that's the way to be broke. The way you build wealth is by thinking like a wealthy person, and what every wealthy person does is they give their money a job before that money hits their bank account. You need to know how much money you're going to save, how much money you're going to invest, and how much money you can spend before you actually earn that money, and you want to systemize that process. A simple way to do this is to follow something like my 75, 15, 10 plan, which says for every dollar that you earn from here on out, whether you earn $100 or $10,000, you take 10 cents of every dollar that you earn and you put the money aside for your savings. You take 15 cents of every dollar that you earn and you put that aside to invest, and then you live off of 3/4 of every dollar that you earn, and that's the money that you spend. Now you might say, well, Jaspreet, that's going to be hard. I'm already struggling living with all of my money going out to my expenses. I never said this is going to be easy. If you want to become wealthy, you have to put money aside to invest, period. If you want to have savings, you can't spend all of your money, period. Your savings are here to protect you against an emergency. This is how you become wealthy. You have to live below your means if you want to have a chance to become wealthy, and this is what wealthy people are focusing on. And this is a system that you can follow. You don't have to start with 75, 15, 10. Start somewhere and work your way up so you have more money going aside towards your investments and towards your savings. That way now every time you get paid, some money is spent, some money is invested, and some money is saved. Once you have 3 different bank accounts and you build a system so you know how much money to spend, invest, and save, now it's time for number 3, automate the process. I've been teaching financial education for a long time, and what I can tell you is that humans make mistakes. And I can tell you this from experience because I have made more mistakes than most people that I have met. And if you rely on yourself to go into your bank account and deposit money into your investment account and savings account, you will make a mistake at some point. You will forget to do it, you will not save enough money, you might not invest enough money one time, and this is where you can automate the process. Most banks will allow you to do this for free. If your bank is charging you money to do this, get a different bank. So now, here's what you do. Money hits your checking account when you get paid. You get direct deposit, or you take a check, you deposit here. Then you create an automatic withdrawal from this account into here and into here. If you know how much money you're making every single month, or every 2 weeks, or every week, well, now you create an automatic withdrawal, so money automatically gets put into your investment account and money gets automatically put into your savings account. That way you don't have to worry about human error. And now you've taken the first step, actually the first 3 steps to become wealthy, because now you have 3 different bank accounts. You've created a system so you know how much money to save, invest, and spend, and now you've automated the process. But let's talk about how you actually make this foolproof and how you can optimize the process. That way you can get to that wealth even faster. Now I want to remind you of this. For those of you that are investors or want to become investors, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every day. Plus, when you join Market Briefs, you'll also get our investing masterclass free as a bonus just for joining. So if you want to get Market Briefs, our free newsletter, and our investing masterclass for free, all you have to do is click the link down in the description below. Now, let's start by talking about how you can optimize your spending. What I used to tell people is if you walk into Macy's and you see a sweater that you really like, before you buy it, give yourself 24 hours. But nowadays, it doesn't feel like many people go into Macy's, so let's say this. You're on TikTok and you see this amazing guacamole maker that you have to have and it's only on sale for a limited period of time. But before you go out and you make that impulse purchase, what I want you to do is follow the 24-hour rule. When it's not something you need, it's this impulse purchase. You find something that you think you're gonna love, give yourself 24 hours. You're not saying no, you're not saying yes, just give yourself 24 hours to think about it and digest it. And if you wake up tomorrow and you still really want the guacamole maker, well now, as long as you can afford it, you're giving yourself permission to buy it. This will allow you to stop impulse buying all those things that you don't need just because every time you go on TikTok, every time you go on YouTube, every time you go on Amazon, you start to get bombarded with these ads of amazing products that you didn't even know that you needed. The second way you can optimize your spending is understanding the difference between a need and a want. You need a car to get to work. You just want a BMW. You need a home to live in. You just want the brand new townhouse. You need some food to eat. You just want the organic blueberries. When you're trying to get your money right and you're spending right, you have to be able to tell the difference between a need and a want because you gotta stop spending so much money on your wants and focus more on spending money on needs. That way you have some extra money to invest and save. But that's gonna require you to really look in the mirror and understand what do you need and what do you want and be honest with yourself. Is there something that you can cut back on? And my goal isn't for you to live small for the rest of your life. My goal is for you to make some sacrifice for a period of your life. That way you can enjoy the rest of your life without having to worry about money. But the only way you can do that is now you start to understand the difference between an asset and a liability. A liability is something that takes money out of your pocket. Your car is a liability, your clothes are a liability, your house is a liability. All these things are liabilities. Yes, your house, I call it a liability, even though most people will say it is an asset because your house is a money pit until you ultimately sell it, and you have to hope that you can sell it for a profit. If you sell it for a profit, sure, it can be an asset, but for most of the time, it's a liability until you sell it and hopefully you can sell it for a profit. But a liability is something that takes money out of your pocket. An asset is something that you buy for the sole purpose of putting money in your pocket. So when I go and I buy a rental property, that is an asset because I'm buying it to make cash flow for me every single month. When I buy stocks, I buy them to put money in my pocket. I buy them either so I get dividend income every 3 months or so I can sell the stock for a profit. When I invest in a startup, I'm buying it as an asset so I can hopefully make money on a startup. When I'm buying physical gold, I'm buying it as an asset. When I buy cryptocurrency, I'm buying it as an asset. When I invest in my own self, my own business, that to me is an asset because I'm investing in my business. That way I can make more money. And so the reason why I want you to understand this is so you can focus less on the liabilities and focus harder on the assets, because what wealthy people want is more assets. What broke people have are more liabilities. And most people think and make the excuse that the reason why I don't have assets is because I don't make enough money. Well, it doesn't matter if you make $20,000 a year or $200,000 a year. What we've seen is that most Americans, even six-figure earners, only have liabilities with no assets. I want you to change the game and start building wealth for yourself. That way you stop spending so much money on liabilities so you can own more assets, because those liabilities, your BMW, your Gucci, that fancy lifestyle is making all those companies rich, but it keeps you broke. And I want you to work hard to make yourself rich instead of just working hard to make BMW rich. Instead of just working hard to make your bank rich. Instead of just working hard to make Amazon rich. I want you to make yourself rich first by owning the asset, not the liabilities. Then the fourth way to optimize your spending is to understand my rule of 5. My rule of 5 when it comes to luxuries, things that you don't need, are if you cannot buy 5 of them, you cannot afford 1 of them. You wanna buy the $1,000 Gucci scarf? Great. If you don't have $5,000 to buy the $1,000 Gucci scarf, you can't afford it. And the fifth way to optimize your spending is no more financing liabilities. If it doesn't put money in your pocket, do not finance it. I was just talking to one of my employees about this, who was telling me how his life has changed now that he no longer has a car payment. He grew up without financial education. Didn't grow up learning about money, didn't grow up learning about investing, that was just a normal thing. And now that he doesn't have a car payment, it feels like a huge weight is lifted over his chest and his body, because we all think that you have to have a car payment. We all think that you have to have these credit card payments because it's normal. But the reality is it doesn't have to be that way, and that should not be your normal. If it doesn't put money in your pocket, do not finance it. The only exception being your house. Yes, I would prefer it if you bought your car with cash and didn't have to worry about a car payment. Yes, that means you'll probably have to buy a cheaper car. Yes, that probably means that you won't be able to buy the same BMW that you wanted. You might have to downgrade to Toyota for a little while. But when you do that, you can invest the difference, and now your investments will be able to buy you the BMW, to buy you the Mercedes, to buy you whatever car you want in the future without having to worry about the price. That's what I want for you. And this also applies to 0% APR financing. When you go and you buy the iPhone for $1,000, they know that if you buy it with 0% APR financing, not only are you more likely to buy it, because it's a lot more painful to see $1,000 leave your bank account, but you'll also probably buy more stuff because you don't have the pain of $1,000 in your bank account. And if you don't pay it off in time, now you get slapped with a very high and very expensive interest rate, because there's no reason why companies would just lend you money for free unless they weren't making money off the back end. So when it comes to optimizing your spending, think about the 24-hour rule to avoid the impulse buying. Think about the difference between a need and a want, if you actually need it or do you just want it. Understand how you want to prioritize assets versus liabilities. Remember the rule of 5 when it comes to your luxuries. And of course, stop financing liabilities that aren't putting money in your pocket. Now let's talk about how do you optimize some of your investments. Your investments are there to build you wealth, but the problem that most people have when it comes to investing is they don't have any sort of strategy. They look for the next hot stock, you look for the next hot cryptocurrency, you look for this next thing on Reddit or internet or whatever some random person on YouTube is saying, and then you throw your money into this thing hoping that you're gonna double your money, and then when that does not happen, you hate the stock market, you hate the economic system, you think everybody is rigged, and you don't understand why everybody else is getting rich except you. And this is where we gotta take a step back and understand what is your strategy. What do you want to invest in? How do you want to invest? Now, you can invest in real estate, you can invest in stocks. I really don't care. Those two have been the proven assets that have been time-tested, stocks and real estate. But you gotta start with a strategy. Do you want to be more of an active investor, or do you want to be more of a passive investor? This applies to real estate and stocks. Active investing is what most people think about when you talk about real estate investing or stock market investing. In the stock market, active investing means trying to find the next company that you want to invest in. You're looking for a shift, that you believe that more money is going to flow into technology. Okay, more specifically, you believe more money is going to go into artificial intelligence. Okay, more specifically, you believe that these companies are going to profit from this shift in money over the next 5 or 10 or 20 years. And now you go out and you invest in those specific companies or funds related to that shift. That is an active investment. I'm not talking about trading. I'm looking for finding a company that you believe is going to be able to see the upswing. That way you can take on more risk for more potential return. Key, more potential return. You're hoping to make more money because you're taking on more risk, but here's the problem. Let's say you invest your money into Amazon, and over the next few years you keep putting more money into Amazon because you believe that Amazon is going to take over the world, but then the CEO does something bad with Amazon. They start to see the profitability fall. They then start to get hit with lawsuits. They then start to get hit with the FTC regulations, SEC regulations, and new regulations by the government, and then they have to file bankruptcy. Not only did you not make any money, but you lost all the money that you invested. More risk for more potential return. The alternative to an active investment is a passive investment, where now instead of trying to find the next Amazon, you're just putting your money into something like the S&P 500. The S&P 500, for example, is a group of the 500 largest companies in the stock market. This might include companies like Amazon, and McDonald's, and Coca-Cola, and Apple, and Nike, and Nvidia. And now you don't have to worry about managing it because it's an algorithm that's giving you exposure to the 500 largest companies. So now if Amazon were on the verge of bankruptcy or is going bankrupt, it would get kicked out of the fund and replaced by another stock, and there's nothing that you have to do. This is called passive investing. And when you do this type of passive investing, the way that you win is by doing something that I call ABB. Always be buying. You set up a system so every week, every 2 weeks, and every month, you just keep buying. No matter what, whether markets are up, whether markets are crashing, you keep buying. Whether it's a Republican in the White House, whether it's a Democrat in the White House, you keep buying. Whether it's raining, whether it's snowing, whether it's sunny, you keep buying. That's the way that you win, assuming that you do it for the long term. By the way, there are funds that give you exposure to the S&P 500. A couple examples are SPY and VOO. Those are both ETFs, funds that give you exposure to the S&P 500. I'm personally invested in VOO as a disclaimer. Now, I gotta also remind you that investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Now you might be thinking, well, Jasprit, what if I wanted to invest in real estate? It follows the same pattern. If you wanted to be an active investor in real estate, this means you're gonna go out and find a deal. Maybe a single family house, maybe an apartment complex, maybe an office building, maybe a retail building, maybe a mixed use building, maybe an industrial building. You find a property that you wanna buy, it makes sense, you do the underwriting, and then you go out and buy it. More risk for more potential return. The alternative to be a passive investor in real estate is to find somebody else's deal, to find a crowdfunded deal, to find some other sort of syndicate deal where you're investing some money, but it's managed by somebody else. These types of deals are everywhere. You can go to a real estate investor conference. There are companies on the internet. You can use my link down in the description to see one of my affiliate partners that can give you exposure to this type of real estate investing, where now you're just investing some money, but you're not the one that's actually managing the deal. It's more passive. So, active investing is you are the manager of this investment. You're still a long-term investor. Passive investing is somebody else is the manager and you're just investing your money, less risk for less potential return. The second thing you want to do to optimize your investments is now research. This is even more important when you're an active investor, but it's still important as a passive investor because you got to research what your investment is. The way that you can improve your returns as an investor is to find a better investment. And how do you find a better investment? It's not just by listening to a random person on YouTube. It's by actually doing the research. It's by actually doing the work. This is what Warren Buffett does all day and night long, is he's researching companies. This is what our market analysts at my company, Briefs Media, spend all day doing. They're researching trends, they're researching shifts, they're looking for where the money is moving, and then we publish a report in Briefs Pro, which breaks down where we believe the money is moving. Again, if you were interested in learning more about how you can be a better investor and what's happening in the markets, you can join Market Briefs for free and get our investing masterclass. And then if you are interested in Briefs Pro later on, you can always join that to get access to more research. But the whole idea here behind your research is to have a reason for investing in whatever it is that you want to invest in. Instead of just throwing your money into random companies, you're researching where you believe you will see the most upside. The better your research, the better your potential returns. I always say potential because sometimes you can get lucky and find a great investment. Sometimes you can do all the research in the world and be wrong. That's the name of the game when it comes to investing. But you can lower some of the risk by investing more time into your research. And then the third part is to actually execute. And what I mean by that is sticking with your strategy for the long term. Anytime you see a market downturn happen, we've seen it happen in 2025, we saw it happen in 2022, we saw it happen in 2020, we saw it happen in 2008, people panic. People freak out. And then they forget, number one, they forget their strategy. They assume now that the world is going to end, the economy is going to end, everything is going to go down, and people panic and they sell and they run away, and then they lose a lot of money. And this is where you have to remember your strategy. You have to remember that your goal is to be a long-term investor, and when things go wrong, go back to the strategy. If you know what it is that you want to invest in, and you see some great investments at a discounted price because people are panicking and selling, that could create a great buying opportunity because recessions and market crashes create more millionaires than any other time because they allow financially savvy investors to come in and buy great investments at a discounted price. And last but definitely not least, let's talk about how do you optimize your savings, because the goal isn't to just save a whole bunch of money forever because we know the savings generally lose value to inflation. The goal is to have a system, a goal, a strategy with your savings as well. And what I like to say is you want to save somewhere between 3 and 12 months worth of expenses in your savings accounts. And the amount of money you save is going to depend on where you are in your financial journey. If you're 25 years old, you're not married, you don't really have any financial responsibilities, you don't need 12 months worth of savings put aside unless you're really scared of risk. But you might only need a few months worth of expenses because, well, you don't have that many financial responsibilities yet, so you can be more aggressive with your investments, which will help you build even more wealth. But now if you're 45 years old, you got kids, you got parents that are getting a little bit older and you have to help take care of them, and you have these other financial responsibilities that are now kicking in, maybe 3 months isn't enough. Maybe you need 6 months or 9 months or a year's worth of expenses put aside to make you feel whole and comfortable. That way, if you got fired from your job tomorrow, you wouldn't have to stress about how your family's gonna eat. You wouldn't have to stress about how you're gonna pay your bills. You wouldn't have to stress about just living life. You could take some time, find a new job, and get your family back on their feet because you have that savings cushion. That's why you wanna have your savings. That way, if something bad were to happen, you don't have to panic. You don't have to go into your credit card debt. you have the cushion to protect you. That's why you want to have somewhere between 3 to 12 months worth of expenses. After a year's worth of expenses, this is where I would take that extra money and just dump it all into my investments, because now I no longer need to save more money. I can take all this money that I was saving and put it into my investments because I have enough cushion now. Now that you understand this, you built different bank accounts to hold your spending money, your investment money, your savings money. You created a system and now you've automated it. Once you've done that, now we've talked about how do you optimize your spending. We talked about how do you optimize your investments. We talked about how do you optimize your savings. Now we actually have a plan to turn your paycheck into wealth. Being wealthy means your investments are making you enough money to pay your expenses, so you don't need a job to pay your bills. The problem is most people will say, just invest your money into the stock market. But what if you don't know what stocks to buy? Or what happens if the stock market crashes and now your portfolio gets cut in half and you were relying on that income to pay your bills? This is